I mean, I think that $1 million Bitcoin is in the cards
Today, I sit down with macroeconomist Lyn Alden
because I do think that Bitcoin could be as large or larger than gold.
about what's next for Bitcoin and the stock market.
I think we're entering another upward liquidity cycle after really like 2+ years of kind of being range bound in liquidity.
We discuss the Fed rate cuts and what comes next. If we only get a 25 basis point rate cut, do you think we'll see a sell-off in markets, even though it's supposed to be a good thing? Also, Lyn gives her real take on altcoins.
Right now, Ethereum's got a bigger market cap than BlackRock. Solana's got like a bigger market cap than State Street.
And watch today's whole interview as Lyn shares her best investing advice. What's the best piece of investing advice you ever received? Click the like button to support me. And let's start, Lyn, with your background.
My background is engineering initially, and then I moved into management for a while, and then got more into finance. So now I do public financial analysis. I'm also the general partner at Ego Death Capital. So kind of a lot of hats over the years.
What is the main mover of markets? Is it global liquidity?
I think in the current regime, global liquidity is the main one. Different market environments over time have had different main movers, but I think that right now liquidity, which is driven by multiple different things, including fiscal deficits in the United States, but I think liquidity is probably the main mover currently.
What's your macro outlook given that we're about to see rate cuts potentially?
So I'm kind of looking for a potential rotation that's similar to the 2002 to 2007 period. That was the last time where a lot of global capital was stuffed into U.S. markets. So strong dollar, highly valued equity markets, emerging markets struggling for a long period of time. And as the U.S. Encountered a recession and then they cut interest rates, it kind of softened the dollar, and then it caused this kind of virtuous cycle for emerging markets, and capital kind of came out of that, and they went on to have a very good several years. So I think that we have a similar market environment to like that period. This is kind of the first rate cut in a while, which kind of opens that catalyst for that rotation. So I'm kind of looking to see if there's follow through with that or not.
So 2002 to 2007, stock market rose. And then the American economy got stronger. That's what you're saying, and emerging economies got weaker.
Um, so which period sorry,
You
like
said
which
you said similar to what we saw in 2002 to 2007. And I just wanted to
yeah,
clarify what that means for traditional markets.
right. So that means I believe it's the opposite is basically that the emerging markets had been weak starting really in the late 90s because emerging markets have a lot of dollar denominated debt. That's where they get a lot of their financing from, and it's often not even lent to them by the United States. It's lent to them by lenders around the world that accumulated dollars from all their surpluses of various capacities. They lend them to emerging markets, and if you imagine, like if you took out a house and your mortgage was in Swiss francs, and the Swiss franc doubled compared to the dollar, you'd be in financial problems with your house, and maybe you're getting cash flows on the house that are in dollars, but your liabilities just like doubled compared to dollars. And that's really what happens to emerging markets when they borrow in dollars, and then the dollar has a big, strong cycle compared to most other currencies. They get squeezed. Their corporate sector, their government sector, and so that was happening throughout the 90s, particularly the late 90s. But when the U.S. weakened in the early 2000s, that actually gave an opening for emerging markets to have a really strong period. And throughout the rest of that decade, like that kind of 2002 to 2007 period, the U.S. economy did go on to recover from that recession, but it wasn't like the leader strength-wise in the world. Basically, the BRICS. That's actually where that name came from. The BRICS. It was such a popular, powerful place for a while. All these different emerging markets. They were kind of the core drivers of the global economy for that decade. And eventually global financial crisis, and eventually, in the 2010s, we entered another stronger dollar environment, and so emerging markets have been in kind of another pressured time frame for quite a while, and this is kind of the first opportunity in a while for that to potentially rotate. So we have to see if there's follow through.
Lyn, for the US, Everybody seems to be expecting a 25 basis point rate cut. Some people are even saying 50. If we only get a 25 basis point rate cut, do you think we'll see a sell off in markets, even though it's supposed to be a good thing?
So potentially because it right now is priced almost 50-50, like the market's not really sure which one they're going to get. Every time a new economic data point comes out, it kind of changes the probabilities for that. So it would only, I think it would only really be meaningful for markets if it came out differently than the market had priced by that day. The other factor is that their language around what they intend to do. So it's not just what they do. Like you can have a hawkish cut, which is that you cut, but then the language around the cut indicates that you can't necessarily expect to cut the next time, or maybe not as big as you think. Or it could be a dovish cut, which is to say they cut, but then they indicate that they're firmly going to keep doing it. So there's both the actual action itself, and then there's also like the follow through, the language around it.
If you were Jerome Powell for 1 year and you could do exactly what you wanted, what would you do rate cut wise for the next 12 months?
Yeah, there's two answers to that question because in one sense, I think that the fundamental algorithm that they work with doesn't make sense. So, for example, I don't think central banks should set interest rates. I don't really believe in price controls, and they set price controls for the price of money. So I kind of fundamentally reject the whole concept. But if I were Jerome Powell and I had a dual mandate of trying to maximize employment and trying to keep inflation in check, I would probably do mild rate cuts as the data come in. I think he's basically trying to balance his mandates. I lay more blame for kind of some of the current situations on earlier heads of the Fed. So during the Greenspan era, the Bernanke era, that's where I think that they could have done significant things differently. But ever since the global financial crisis, I view a lot of this as like locked in now. So I don't, I think that I would not really fundamentally do much different than him. I guess the one thing I would do differently is I'd be more transparent about the deficit being an issue. Um, During the pandemic, basically the central bank is supposed to be independent. And during the pandemic, he made the rare move of saying that the economy needs more fiscal support. So, he can only do monetary policy. He's saying we need more fiscal support. And we got that in spades. And, we eventually got inflation from it. And now that we have ongoing very large fiscal deficits, whenever he's asked about the deficit, he basically says it's not my area to comment on. Instead of, if he was being more symmetrical with his kind of occasional public recommendations, I think it'd be prudent for him to say, look, it's really hard to do my job on inflation when you're running 7% of fiscal deficits compared to GDP in a non-recession environment. Like that's a source of where a lot of this inflation's coming from. But he's kind of too like now he's suddenly going back to never wanting to talk about politics, even though he has in the past called for more fiscal support.
I want to talk about Bitcoin, but last question on traditional markets. Stock market is coming off of all-time highs. With the rate cuts, do you see the stock market virtually going up for the next year?
I don't have a strong view about the next year. I think the stock market is rather expensive, especially the large ones. When the stock market's strong, people often assume it's like very risk-on behavior. The ironic thing in this case is it's kind of a bubble in risk-off assets, which is to say that there's not much interest in cyclicals. There's not much interest in emerging markets. There's not much interest in Bitcoin from kind of the broader space. There's not really an interest in those types of assets. Gold has outperformed the S&P 500 over the past 3 years, mildly. If you kind of like look at S&P 500 priced in gold, it's been this like slow rollover. The names that are doing really good in the stock market are the trillion-dollar profitable monopoly tech stocks. That are basically the low risk stocks. Costco is trading at like 55 times earnings. It's like this bulletproof blue chip company. And every investor says, I don't want to touch banks. I don't want to touch energy. I don't want to touch emerging markets. I don't really want to be in anything cyclical. I want to put all my money in big cap tech and Costco and stuff like that. And that's actually, and the funny thing is that gets dangerous because not that Costco is going to have a problem, but you can have a scenario where it goes down from 55 times earnings to 35 times earnings, and the stock underperforms the fundamentals. So right now, I think a lot of this stock market doing well is actually ironically somewhat risk-off behavior. Um, I'm a little bit more interested in the less expensive, choppier areas of the market, whereas I am somewhat concerned about these big, expensive areas that are, I would say that many of them are bid to price levels that don't really match their fundamentals.
Lyn, you are a Bitcoiner. Can you talk about your journey into finding Bitcoin?
Sure. I mean, I found it multiple times. Basically, it kind of takes multiple touches with it usually. I knew someone that was mining it on her like gaming computer back when you could just do that. And I thought, oh, that's neat. I maybe I should do that because I had like, I had a decent graphics card, and I was like, maybe I should do that. I never got around to it. Then a few years later, it had another one of those like bull runs, and I was like, maybe I should buy a little bit of it. I looked at the exchange at the time, and they were like really sketchy looking. And I was
What
like, I
year?
gotta that second one would have been in 2013, 2014, 2015, something like that. Um, and I was looking at the exchanges and they were really sketchy looking. And I was like, I gotta like put more time into this to make sure I don't get scammed. And again, I just didn't. Like I just, I had life going on and I just kind of didn't get back to it. When it had the big bull run in 2017, I had a couple interactions with it. One was I was I was an engineer at the time still, uh, basically running technical procurement for an engineering facility, and suddenly graphics cards doubled. And I was like, why? Like, why are graphics cards doubling? And one of our engineers was like, oh, that's Ethereum. And I was like, so what? Like, what's Ethereum? And then so I did this whole research thing. Okay, what's going on with Ethereum? What's going on with Bitcoin? I wrote my first public piece about the space in November of 2017, and I said basically that the tech was very interesting, but that I thought that it was rather euphoric at the time. And of course, over the next month, like it soared into the top, and then had this prolonged bear market. What I tried to do this time though was not forget about it. All those prior times, I would kind of see it and think it's cool, and then kind of just forget about it. But after this was like the third time of doing that, I'm like, okay, I'm not going to make the same mistake. So during the bear market, I kept following it. And then that's, especially during the COVID crash, like that March 2023 sell-off, when it started to come out of that is when I bought in pretty heavily. And I've been bullish ever since.
And you don't have to get too specific, but is it 5% of your portfolio, 10%? How much conviction?
So I have some public portfolios, and I keep it pretty manageable there. Like I'll do a 5% allocation, and then during a bull run, as it grows into like a double digit allocation, I'll kind of like rebalance it back down. Um, because a lot of people just kind of follow that portfolio, and so I just by default, it's kind of like the benchmark is a fairly stable portfolio, just spiced up a little bit. For my own allocation, it's double digit percentage. It's a rather large allocation. Part of that is because I bought in with conviction, but then also just because it's outperformed most other assets since I've owned it. And therefore it appreciated to become a rather large position. So a lot of my position is just from not selling. But then in addition, because I'm a general partner at Ego Death Capital, we invest in Bitcoin related startups. So I also have venture exposure that is kind of indirectly tied to Bitcoin as well.
Do you put how much credence do you put in the 4-year cycle for Bitcoin? And then I want to pivot that the fourth year is coming up next year, 2025.
So I put less emphasis on that than others. I mean, obviously over time, the halvings are important because the new supply coming to market is relevant. So as that goes down, that is relevant. But I generally view global liquidity as being more impactful. I've done analysis. Actually, I have a report coming out with a colleague, and we did analysis of liquidity correlations. Bitcoin versus global liquidity, and then also other assets compared to global liquidity. And it does turn out that in any given 12-month rolling period, Bitcoin is more correlated with global liquidity than any other of the major assets that we do. So stocks, bonds, gold, foreign stocks, things like that. They're not, they're many of them are just to varying degrees correlated with liquidity, especially stocks. But Bitcoin is the most correlated with liquidity. And most of those highs and lows are associated with liquidity rising and falling. And the two major components of liquidity, the way I measure it, one is basically the rate of global credit creation. And then the other factor would be the strength of the dollar relative to other currencies, which is relevant for what we talked about earlier, which is that a lot of countries in the world have dollar-denominated debts. That's kind of the unit of account for a big part of international finance. And so whenever the dollar is strengthening, that's actually putting a lot of pressure on global liquidity. Whereas when the dollar is weakening compared to other major currencies, that's actually pretty positive for liquidity. So I think a lot of the correlations that people associate with the 4-year cycle are actually liquidity, which kind of is overlapping with it. Even though I do think that there also is some relevance from the halving.
And you believe global liquidity is increasing next year. Where does that put Bitcoin?
As a base case, I would expect higher. I'd say next 18 months or so. It's hard to time things precisely. Um, we are generally seeing as the Fed starts to cut interest rates, we're seeing a softer dollar. It doesn't mean it's going to be a straight line, but basically some like the catalysts that kind of really propped up the dollar are kind of fading. And the dollar, the United States runs a structural trade deficit, which for most currencies would be very weakening for their currency over time. But the United States is also the global reserve currency, so we have all those dollar-denominated debts around the world, and all of that represents inflexible demand for dollars. So there's this balancing point. Whenever we tighten monetary policy, we actually are pretty capable of strengthening the dollar. Whenever we loosen monetary policy, that tends to be pretty dovish for the dollar. And so because I expect a somewhat weaker dollar and I expect probably going back to more global credit creation by next year, probably the year after that, I think we're entering another upward liquidity cycle after really like 2+ years of kind of being range bound in liquidity. So Bitcoin has followed this liquidity cycle pretty closely. And my base case over the next 18 months is probably for both liquidity and Bitcoin to go up, although I don't really have a view of, say, the next 3 to 6 months. I mean, these are processes that take time to play out.
Over the next 18 months, if you would you share your base case, bear case, and bull case for Bitcoin price?
So a lot of that is just psychological. I'd be surprised if we don't see 100K. I mean, that's kind of like a back of the envelope rough expectation where I would think that I would consider the cycle stunted if we don't reach that. But other than that kind of rough level, I mean, there are easy scenarios that you can imagine, over the next 18, maybe 24 months, you can have a wall of liquidity and institutional buy-ins and some sovereign announcements, and you can get the crazy numbers. Or you could barely get over 100K if you even make it there. So I don't really have views because I didn't have to predict not just liquidity, but like what individual nation states will do, or like, whether there's gonna be like another MicroStrategy that decides to come in. So it kind of comes down to like one billionaire's decision or not, right? So rather than price targets, I try to just have a sense of direction and kind of long-term prices that make sense, not any one cycle.
Lyn, what's your view on altcoins like Ethereum and Solana?
I've most of my writings have not been very constructive toward altcoins. I have been bullish on stablecoins for years. Obviously not the price, but the volume of stablecoins that is going to exist, and that has played out. So ever since I wrote that, the size of the stablecoin market keeps growing. That's basically a very strong use case. Obviously, blockchains that enable stablecoins to run are therefore going to be relevant as well. I tend to be more bearish on these more speculative use cases. So while I think, for example, digital collectibles are a thing, they become these bubbles and then they just like diffuse for long periods of time. Or the DeFi bubble, a lot of it was just kind of speculative aspects to it. So while I do think that there's a use case for basically anything that allows stable coins to run or allow stable coins to be like, traded or leveraged for other things. I mean, that there's relevance there. Um, I think tokenized assets are relevant. So for example, when like a hotel in El Salvador wants to like basically crowdsource some of its funding, it doesn't really have local depth of markets to issues like basically what is a security on some sort of chain that people can buy into is useful. So basically, I'm on board with the real world assets tokenized thesis to some extent, on board with stable coins, but I'm not very bullish on long-term value accrual for a lot of these underlying chains. And one thing I pointed out is, I mean, like for example, when ETFs came onto the market, they really took share from mutual funds. They're just, for the most part, a better product. But when you look at all the big ETF issuers, BlackRock, Vanguard, State Street, Invesco, if you add their market caps together, they're actually not that big, right? So their assets under management are very big because ETFs are so successful. But the actual value of the companies themselves, I mean, they're multi-billion dollar companies, but they're not like trillion-dollar companies. Um, and right now, Ethereum's got a bigger market cap than BlackRock. Solana's got like a bigger market cap than State Street, last I checked, or bigger than Invesco at least. I think even some meme coins are bigger than Invesco. Um, and so I think the size that some of these have grown to is arguably already kind of forward projecting what their value accrual could be, basically the size of large companies. So I'm not saying that there's no use case for these things, and there has been a lot of interesting research come out of some of these areas, like roll-ups and things like that. I generally am not very bullish on long-term, prospects for most other things.
The Bitcoin ecosystem and projects finally being able to be built on Bitcoin, does that change your outlook in terms of value, market cap for the Bitcoin network?
For the most part, no, because I think that the biggest kind of market that's being addressed here is good money, right? So we live in a world where if you add up all assets together, it's something like 900 trillion. Like it's a pretty comically big number. And of that, like the bond market is like hundreds of trillions. The real estate market is hundreds of trillions. The equity market's like 100 trillion. The currency market is like 100 trillion. And then there's like, gold is under like 20 trillion. Fine art is some trillions, is basically the whole kind of long tail of other types of assets. Um, and basically, if you have a really good new money that the world accepts over, a 20, 30, 40, 50-year period as it kind of reaches whatever its total addressable market is, I think that's a massive market. That's like a huge market that could be bigger than gold, for example. Whereas I think that, the other things that can be done with it are interesting. But they're more like trillion-dollar opportunities, not like $10 trillion opportunities. So I mean one of the examples is Guatemala timestamped its election, 2023 election into Bitcoin, right? So they basically they all people cast their votes, and then at any given table, I think there's like 25,000 vote counting tables throughout the country, and they vote their, X number of votes that they're kind of assigned to, and then the vote counters sign it and observers sign it, and then that sheet is scanned. And then immediately timestamped. It's hashed into the Bitcoin blockchain, so it's not actually stored on Bitcoin. It's stored in some other, any sort of other servers and backups and things like that. But the point is that you can then point to the Bitcoin blockchain and say it was hashed into Bitcoin at this time. It was like time stamped, and that this specific thing was not altered from that time period. And it was put in like literally minutes after all those people signed it, and they did that for the whole nationwide election. So
Wow.
that's using Bitcoin for its basically being the most immutable database in the world, regardless of it being money. It's just it's a database. So there are non-monetary use cases for it, including some of these other layers that could be built out. And they're interesting, especially from a venture standpoint. They can open up interesting investment opportunities. But for the network itself, I view the biggest use case is basically globally portable store of value and international value transfer settlement, basically.
Kathy Wood is on record that she believes Bitcoin will hit $1 million by 2030. What are your thoughts on that?
I mean, I think that $1 million Bitcoin is in the cards, because I do think that Bitcoin could be as large or larger than gold. And I think gold's probably going to increase its market share as well. I mean, it's been doing well in recent years, and I'm still bullish on gold. So I think that both gold and Bitcoin, I think, are going to have a little more prominence in the years ahead. And Bitcoin at $1 million is only a 20 trillion-dollar market cap, 21 trillion fully diluted. So it's not really that big of a market, especially over time when you include another 6 years of inflation and money supply growth. Maybe a million by 2030 is a little bit aggressive. Like if I were to put my kind of guess hat on, I'd probably give myself till 2035 or something. So I don't really have specific time frames like that. But I do think that that's a level that would make sense for Bitcoin to eventually get to, if it continues to be like the global leader in digital money and portable store value.
Given everything we've discussed about macro in this conversation, what would you say is the best buy in markets today?
I mean, long term, probably Bitcoin. I think that anyone in traditional finance that has no Bitcoin position should have a Bitcoin position. Obviously, it doesn't have to be like all in, like degen, leverage long, but like not having any Bitcoin, I think is the easiest low hanging fruit to fix. Even if the thesis doesn't work out, if you got 3% and it's fine. But if it does do some of those really bullish outcomes, it's good to be on the right side of that, even with a small position. And aside from that, I think there's like other assets out there that I think could do very well, but they all have counterparty risk. So, for example, I think that Chinese equities are super cheap right now. Nobody wants them. And I'd say there's a high probability that 5 years from now, they've done very well from these low levels. But then there's some minority position where you literally just get zeroed out from owning them. Kind of like if Americans owned Russian stocks, a little over 2 years ago, those companies are still there, but your claim on those assets is basically just sanctioned away. So any investor has to take that into account. So I think that there are a lot of opportunities in equity around, but I would say that Bitcoin and Bitcoin Venture I mean, it's certainly where I'm focusing a lot of my time on.
Would you name any of the Bitcoin venture that you're invested in?
Well, so at Ego Death Capital, we have a public portfolio. So it's Lightning infrastructure, it's Bitcoin brokers around the world. It's we basically look into multiple different things. So anything that involves helping people buy it, helping people trade it, helping infrastructure for spending and things like that. So we have exposure to Fedi, which has a wallet that is more private and more distributed than we see from many other wallets. So there's a lot of opportunities out there. We tend to focus on the less speculative use cases, so less about like trading and leveraging for the most part, although trading is still relevant, and it's more instead about kind of like long-term utility and long-term, kind of like the still basically the basics of the ecosystem.
Given everything we've talked about in macro thus far, what would you say is the worst buy in markets?
I mean, for example, I'm not bullish on Costco at 55 times earnings. It actually reminds me of, so in the late 90s, everyone, of course, is knows the dot-com bubble. But what they're less familiar with in many cases is if you look at like Coca-Cola stock, they were trading at like 50 times earnings, and Walmart was trading at like 50 times earnings. So a lot of these kind of blue chip consumer staples or consumer retail, that kind of thing, they were also trading at very high valuations. And over the next 10, 15 years, both Walmart and Coca-Cola continue to grow their earnings, their revenue, and all that, but their stock prices went like sideways for like 10 years. Because even as their earnings doubled, their earnings multiple, their price to earnings ratio got cut in half. They went from 50 to like 25 times earnings, which is back down to like reality. At some points, they even went lower, like Walmart went into the teens for a period of time. And so there's stocks like Costco, where it's just really hard to justify how this is going to perform long term. It doesn't mean it has to do bad next year or even the year after. It's already stayed this high longer than I would have guessed. But I would just say that investors have to be cautious about overpaying for something that's very good. Something can be great, and you can turn it into a bad investment if you buy it for like twice of what it's worth.
Lyn, a lot of millennials are trying to buy a house, in the next few years. Is there going to be a good time? Do you think housing prices will go significantly lower?
I think probably not, but I do think that over time their affordability will improve. Kind of my expectation of houses, kind of like actually what we saw with, say, Coke, where the stock didn't really necessarily crash, just kind of like chopped along for like sideways for a long period of time as everything else caught up to it. Like fundamentals caught up, the money supply caught up, things just kind of eventually became cheap through time rather than direction. And I think a lot of houses might do that, which is that they don't do very well in inflation adjusted prices. And they don't necessarily crash. I mean, obviously, some of the cyclical markets have already come down quite a bit from their kind of peak highs, but a lot of the linear markets are holding up well or even hitting new highs. But I think that their inflation adjusted performance is probably not going to be great. And that over time, wages will kind of grow into them, and new supply will kind of keep over time chipping away at some of that. And then also, I think we'll have moderately lower interest rates, which increase the affordability a little bit. But I do that's gonna be. I do expect that probably be like a pain point for quite a while. This whole housing affordability issue. I think that's unfortunately probably going to take a little bit more time to unravel.
What's the best piece of investing advice you ever received? And if you remember who gave it to you when you were coming up?
It's hard to say, but I would recommend a book, The Most Important Thing by Howard Marks. And the reason that book's relevant to the question is uh, Marx would often find himself like he'd be like, the most important thing, and he would say what it is, and then like another context, he'd be like, what the most important thing is, and it's like a whole nother thing. So as kind of a joke, the book is every chapter is like another most important thing. So you get a number of individually powerful pieces of investment advice from, I mean, he's a billionaire investor. He's a professional investor that's done very well. And so that is in my opinion, a really good entry book for good investment advice.
Lyn, thank you so much for sharing your time. Would you just give final thoughts to the crypto community as we head into Q4 of this year?
Sure, I would say that probably spinning up on global liquidity is helpful. Basically, and the way there's different ways to measure it. I look at global broad money supply and then denominated in dollars. So basically, you add up the value of all major currencies and you translate that to what is its dollar value. And that's relevant because there's a lot of dollar denominated debt in the world, so that dollar denomination is actually pretty important. And generally speaking, Bitcoin's done a very good job of tracking global liquidity direction wise. Um, other assets, it's a little bit more complex. Um, and in general, I would say from a long-term value standpoint, obviously people are gonna trade, but for long-term value, uh, think where value is going to accrue. Generally, we've seen these kind of waves of narratives. They have a moment in the sun, but then they rarely reach their prior highs again, especially when denominated relative to Bitcoin. So be cautious out there. But I do think that liquidity is probably a very good kind of indicator to be aware of for the direction of the space in any given 12-month period.
And when will we know when liquidity stops? Is that when the rates start going back up again? I know that's, not anytime soon. But when do we
So
know?
rates, yeah, so rates are one variable. Basically, whenever you have a macro thesis that the dollar is going to strengthen markedly, that'd be an end or a period of time. Um, the part of why we've been range bound for a while is the Fed's quantitative tightening. So basically, the end of the prior liquidity cycle. So we had a really big liquidity cycle in 2021, and by 2022, the Fed was like, "Oh, this inflation's out of control. We have to go all at it." So they raised rates. They did quantitative tightening, and so 2022 was a really bad year for liquidity. And we bottomed in early 2023 and kind of started rising again, but still in this like sideways like consolidation band, like barely above those 2021 highs. Same thing for a lot of other countries. And so you kind of it's a lot of it's what the central banks are doing. A lot of it, you can look at the rate of change of bank lending. A lot of this is available for free on St. Louis Fed's website. They have their big data analytics. You can look at the rate of bank lending. You can look at uh, what the Fed's doing with their balance sheet. You can look at interest rate comparisons, which can strengthen or weaken the dollar. So I think the next couple things to watch are one, we're going to go through a rate cutting cycle. And then probably by the end of 2025, the Fed's going to end their quantitative tightening. And when they do that, that should also be like a second improvement to liquidity. But whenever they kind of go back to a period of tightening, or the dollar gets really weak and then kind of starts finding a floor and rolling back up, that could be the end of this particular liquidity cycle.
I encourage everybody in the audience, links for Lyn down below, subscribe, follow. Lyn, thank you so much.